Welcome to the Deep Dive. Today, we're taking a closer look at Caterpillar Inc.'s first quarter 2025 financials.
Yeah, we've got the official earnings release here, dated April 30th, 2025.
And our goal really is to get past just the surface numbers,
Yeah.
understand what's actually happening with their performance.
Exactly, because you see these headline figures like sales dropping, but then they're also deploying a lot of cash back to shareholders.
Right. It seems a bit contradictory on the surface.
Yeah.
So we want to figure out what's the real story behind these signals from this, well, industrial giant.
Let's do it. We're not just reading out figures. We're trying to connect those dots, see the bigger picture.
Okay, so let's dive into those headline numbers first, just to set the scene.
Good idea.
All right. Top line, sales and revenues for Q1 2025 came in at $14.2 billion.
Which sounds like a lot, and it is, but it's actually down.
Yeah, down 10% compared to the same time last year when they hit $15.8 billion.
And profit followed suit, right?
It did. Profit per share dropped from $5.75 down to $4.20.
Okay. And the adjusted figure. Similar story. Adjusted profit per share went from $5.60 to $4.25. So definitely a noticeable decrease across the board.
Significant drops, yeah. Now, what's really interesting is why revenue fell. The report points a finger pretty clearly.
It does. A $1.1 billion drop in sales volume. That's the main culprit they identify.
Right, lower volume.
And here's where it gets, well, kind of fascinating for you listening. They say this lower volume is mostly because of changes in dealer inventories.
Ah, the dealers. So the independent businesses selling the yellow iron.
Exactly. They changed how much stock they were holding. And that just makes you wonder why. What drove those changes?
Well, dealer inventories are often like a barometer, aren't they? They can signal what dealers expect future demand to look like.
So if they cut back on stock,
It might mean they're seeing or expecting fewer customer orders coming down the pipe, or maybe they just stocked up heavily before.
okay, so get this. In Q1 2025, dealer inventory actually increased by $100 million.
Which doesn't sound like cutting back. No, but wait. Compare that to Q1 2024. Back then, dealer inventories increased by a massive $1.4 billion.
Ah, okay. That's a huge difference. $100 million versus $1.4 billion.
Exactly. So it suggests a much more cautious approach from the dealers this year compared to last. A dramatic slowdown in inventory build.
That is a really critical point for you to pick up on. That massive change in the rate of inventory build year over year, it strongly implies something shifted in dealer sentiment or maybe their strategy.
Okay, let's switch gears slightly to profitability. Sales were down, we know that, but the operating profit margin also tightened up,
Right. It was 18.1% in Q1 this year.
down from a pretty healthy 22.3% in Q1 last year. And the adjusted numbers show the same kind of squeeze. What was putting the pressure on those margins?
Well, the report connects it back to those sales issues mainly. Two big things.
Okay,
First, that lower sales volume we just talked about. That knocked about $650 million off the operating profit.
makes sense. Sell less, make less profit.
And second, about $250 million came from unfavorable price realization.
Unfavorable price realization, meaning they just weren't getting as much money for each machine they sold, on average.
Essentially, yes. Could be more competition, maybe shifting demand patterns, maybe even input cost changes affecting what customers are willing to pay. So, yeah, sold less and got a bit less for what they did sell.
That definitely paints a picture of pressure on profits,
Yeah,
lower volume and pricing headwinds.
for sure.
But, and this is a big but, despite all that, their cash flow situation and what they did with that cash, that looks pretty solid.
That's right. Even with sales down, they still generated $1.3 billion in enterprise operating cash flow.
And they ended the quarter with a decent chunk of change, right? $3.6 billion in cash.
Yep. And what's really telling, something for you to think about, is what they did with their cash. They pushed out $4.3 billion to shareholders.
Wow, $4.3 billion. How did that break down?
Mostly share buybacks, $3.7 billion on repurchasing their own stock, and then another $6.7 billion in dividends.
Okay, so even in a quarter where sales and profits took a hit, they're prioritizing returning significant cash to investors. That says something, doesn't it?
It really does. It suggests, confidence in their underlying financial strength, maybe their long-term view, and a clear focus on shareholder value.
Definitely makes you think.
So let's go deeper now. Back to those consolidated sales figures. We need to understand the variations across the different parts of their business.
Okay, so the total drop was $1.55 billion, or 10%. We know $1.1 billion was volume, $250 million is price.
And that dealer inventory point is key.
It really is. That $100 billion increase this Q1 versus the $1.4 billion last Q1, it just highlights such a different posture from the dealers, signaling something.
Yeah. And this caution seems widespread, at least in terms of sales results. Sales were down across all three of their main segments: construction, resources, and energy and transportation.
Let's break this down for you listening. Construction industries got hit hardest. Sales there dropped by $1.24 billion. That's 19%.
19% is a big chunk.
Huge. And the drivers. Mostly lower volume. Again, that was $820 million of the drop. And unfavorable price realization chipped in another $355 million.
Okay. And what about dealer inventory, specifically in construction?
Interestingly, for construction industry specifically, dealer inventory actually decreased slightly in Q1 2025. Last year, Q1 2024, it had increased.
So in construction, dealers weren't just ordering less, they might have been actively drawing down their existing stock?
Seems like it. Which really reinforces that idea of maybe seeing lower demand ahead in that sector, doesn't it? Could be a bit of a leading indicator there.
That's a crucial distinction for you. It really points towards potential softness, specifically in construction markets, at least from the dealer's perspective.
Okay, moving to resource industries. Their sales were down $309 million, or 10%.
What drove that?
Again, lower volume was a big piece, $179 million. Unfavorable price added $50 million to the decline. And then there was currency impact.
FX. Always a factor for global companies.
Yep, $46 million unfavorable, mostly due to the Australian dollar weakening against the US dollar. And the report actually notes lower end-user equipment sales were the main volume driver here.
So less direct buying from the mining companies and quarries themselves, not just dealer adjustments.
Seems that way.
And the currency effect just shows you how these global economic tides can wash over results.
Definitely. Okay, third segment, energy and transportation. Here, the sales decrease was smaller, down $113 million, just 2%.
Only 2%. What happened there?
Well, volume was lower by $175 million.
Right.
And currency was unfavorable too, $69 million, mainly the euro this time, plus lower intersegment sales.
But that adds up to more than the total drop, so something must have offset it.
Exactly. They actually had favorable price realization in E&T, a positive $155 million.
Wow, okay. So unlike the other segments, they were able to command better prices in energy and transportation. That's really interesting.
It really is. It suggests the market dynamics there are quite different. Maybe stronger demand or maybe less intense competition for things like engines, turbines, locomotives.
That's a key insight for you. It shows the value of their diversification. Even when construction and resources are down, E&T can sometimes hold up or even improve on pricing, offers some stability.
Definitely. Now, geographically, this is also quite mixed. Let's take construction again. North America. Sales down a whopping 24%.
24% in North America. That's significant. Could be the housing market slowing, infrastructure spending patterns. Hard to say exactly without more data, but it's a big regional hit.
Resource industries also saw North America's sales fall, down 14%. But look at Latin America for resources. Sales were up 18%.
Okay, a bright spot. That could be tied to specific mining projects, maybe oil and gas activity in LATAM, boosting demand for their resource-focused equipment. Shows you it's not uniform globally.
Exactly. And for energy and transportation, North America was actually up 6%, kind of bucking the trend for that segment's overall small decline.
Interesting.
But EAM, that's Europe, Africa, Middle East, saw a 13% decrease in E&T sales. So again, big regional swings. It really shows you the complex map they operate on.
Absolutely. These geographical variations really underscore how sensitive they are to different regional economies. Vital for you to remember when looking at these big multinationals. Okay, shall we pivot to profit? See how all the sales movement hit the bottom line?
Let's do it. The consolidated operating profit picture, well, it mirrors the sales trend. It decreased by $940 million.
Which is about 27%, right? Landing at roughly $2.6 billion.
Yeah, $2.579 billion. And like we touched on, the main culprits were that lower sales volume costing $652 million in profit and the unfavorable price realization, another $250 million hit.
Now let's look segment by segment for profit. Construction industries obviously took a big hit on sales, so profit.
Big hit on profit, too. Down $740 million. That's a 42% drop in profit for that segment.
Wow, 42%. And the margin?
Yeah, the profit margin in construction really compressed, fell from 27.5% last year down to 19.8% this quarter.
That is a stark decline for you to see. The combination of lower volume and weaker pricing really hammered profitability there.
No kidding. Resource industries.
also saw profit decrease, down $131 million, or 18%. And their margin dipped a bit too, from 22.9% last year to 20.8% this year.
So both big equipment segments saw profit go down pretty significantly. But energy and transportation,
Yeah.
that was the outlier on sales price. How did profit fare?
It was the outlier on profit too. It actually increased slightly, up $13 million, which is about 1%.
A profit increase. Even a small one is notable here.
And the margin ticked up slightly as well, from 19.5% to 20.0%. It really highlights the resilience there, likely thanks to that pricing power we saw.
That's definitely a key point for you. E&T holding its own, even improving slightly on margin while the others struggled. Really shows the strength there.
Absolutely.
Now there's also the all-other segment, bit of a catch-all. That swung to a loss.
Yeah, a $21 million loss this quarter compared to a $24 million profit last year. That can be things like restructuring costs, sometimes certain corporate overheads.
Right. And speaking of corporate stuff, corporate items and eliminations actually improved slightly, helped the bottom line by about $14 million compared to last year. Better management of those overheads, perhaps?
So yeah, a very mixed picture on profit across the segments, with E&T definitely being the relative bright spot for you to note.
Okay, let's quickly touch on a few other financial bits.
Yeah.
Other income expense, that line item decreased.
Yeah, it went from $156 million of income last year to $107 million this year.
And the report says that was mainly due to unfavorable foreign currency impacts again. Just shows you, if you're following global markets, how these currency swings can ripple through the income statement.
It does. Hits non-operating income noticeably for a company this global.
Taxes also played a role. The effective tax rate went up.
Right, from 19.5% last year to 22.3% this year. Adjusted rate went up too.
They mentioned some specific things affecting that.
Yeah, discrete items.
Yeah.
Things like stock-based compensation effects, gains from divestitures last year that weren't repeated. Those kinds of things impact the rate year over year.
So understanding that tax rate is pretty important for you to get the true after-tax picture. Higher burden this quarter.
Exactly. Now we have to come back to that cash deployment. It's just such a big number.
It really is. $4.3 billion returned to shareholders. $3.7 billion in share buybacks, $0.7 billion in dividends.
You know, when a company buys back its own shares, it reduces the total number of shares out there.
Right, fewer slices in the pie. So even if the total profit, say, stays flat, the profit per share can go up. Good for investors holding the remaining shares.
It really underscores their financial strength, or at least their confidence, and that commitment to investors, even when sales are bumpy. It's a strategic choice.
One last segment detail. Financial products. Their financing arm.
How do they do?
Revenues were actually up slightly by 2%, but their profit down significantly by 27%.
Ouch. Why the big profit drop?
Two main things mentioned. They had a one-off insurance settlement gain last year that didn't repeat, and this year they set aside more money for potential credit losses, higher provisions.
Okay, so maybe being more cautious about loan performance.
Well, interestingly, the report also says that actual credit performance, like past due accounts and write-offs at Cat Financial, actually improved.
Ah, that's a crucial nuance for you. So the profit drop wasn't necessarily because loans are going bad faster. It was more about that missing insurance gain and maybe just a more conservative provisioning policy, even though underlying credit quality seems okay, maybe even better.
Exactly. Lots of layers there. Finally, let's quickly bring in what management said.
Yeah, the qualitative stuff. What did Umpleby and the incoming CEO, Creed, have to say?
Pretty standard positive framing, Praised the team, talked about supporting customers, called the results solid despite challenges, highlighted the strong balance sheet, the shareholder returns.
The usual reassurances.
Right. They also stressed their long-term strategy for profitable growth, the benefits of their diverse business mix, and different end markets they serve.
That emphasis on long-term profitable growth. Given these Q1 numbers, you have to wonder what levers they think they can pull in the near term to get back on that track. Maybe focusing even more on E&T, managing costs.
Good question. It suggests they see this current situation, the sales dip, as maybe cyclical or related to those inventory adjustments, not necessarily a fundamental long-term problem.
Yeah, that's the likely message they want to send.
Okay, so let's try and wrap this up for you. Key takeaways from our deep dive into Caterpillar's Q1 2025.
Well, definitely lower overall sales and profit. That's clear.
Driven mainly by lower volumes in construction and resource industries. And that seems tightly linked to those big shifts in dealer inventory behavior compared to last year.
But energy and transportation showed some real resilience, didn't it? especially with that pricing power leading to a small profit increase.
And despite the revenue headwinds, the company generated solid cash flow and made returning a large amount of cash to shareholders a clear priority.
Yeah, that $4.3 billion is a statement. What really stands out as intriguing to me, though, are those contrasting inventory trends.
How so?
Well, overall, dealer inventory increased slightly, but in construction industries, it actually decreased. And we saw those big regional sales differences, like North America construction falling sharply. What's causing that specific pattern? Is it really fine-tuned demand forecasting by segment and region? Or maybe supply chain quirks hitting certain areas? Or just very different market vibes in different places?
That's a really good point for you to ponder. What is driving those different responses? And thinking about these results, it really does give you a window into the health of major global sectors: construction, mining, energy, transport. CAT's performance is kind of a bellwether, isn't it?
It often is. Which leads to maybe the final provocative question for you listening. You see sales volume drop, but you also see this massive cash deployment back to shareholders. What signal does that combination send about Caterpillar's own outlook? Are they hunkering down, focusing on shareholder value during a soft patch they expect to pass? Or is it maybe a sign of a strategic shift, perhaps seeing fewer high-return growth opportunities right now, so returning cash is the best use for it?
A strategic recalibration or just riding out a temporary wave? Something to definitely keep an eye on as we look towards their next quarter's results.